What's up, duly diligent investors? Today we're back with another high-yielding dividend ETF. It's called SPYI, ticker symbol SPYI. Let's see if this ETF is worth your precious investment dollars, or if it's as useful as a screen door in a submarine. What the heck is SPYI? It's a dividend-focused ETF like everything else on this channel. It's like that friend who always splits the bill with you. Pretty sweet, right? It pays you for doing nothing, so it's pure passive income. And they also pay monthly, so you get that sweet, sweet feeling of a reliable paycheck. It's designed to track the performance of the S&P 500 index, which targets companies that shell out good old reliable dividends. How does it make money? Simple. It invests in companies that regularly pay dividends. You're holding a dividend ETF composed of dividend-paying companies. It also tries to capture some equity appreciation while producing this nice 12% dividend. Of course, you can't really have your cake and eat it too. As dividend investors, we all know it's either high yield with high risk or low yield with low risk. SPY tends to gravitate towards the latter. It's managed by Neos Investments. This company also manages a few other ETFs such as QQQI, which you can guess uses the same strategy except it's for triple Q. It also manages NUSI and USI, which has had a bad rep, so I can guess that can immediately turn some people off. If you fell for the downside protection of NUSI, you're not alone. The fund was incepted August 30th, 2022, so it's been a little over 2 years. Since then, it's gained a whopping 8% in capital appreciation, which is nothing to write home about. But then again, it's nicer than being negative. At least your principal has remained relatively flat. But the dividends paid, oh, they paid well. With an average yield of about 12% for the past year, it's been paying nicely. Dividends have been relatively consistent since inception, which is just around 50 cents per share. So in a way, it's matching normal, and I say that with air quotes, market returns through dividends, while also getting a small price appreciation, which is like dividends on top of dividends. It's not terrible given that the dividend yield is pretty high. It's like buy and hold, except you get a paycheck every single month with its monthly distribution cycle. My favorite. I know a lot of people say monthly, quarterly, or annually, doesn't really matter, but honestly, tell me it doesn't feel good to get a paycheck every single month you can spend on pizza and beer, or pay off your phone line. Consistency is a beautiful thing. You also get that very, very slight compounding effect depending on how big your port is to buy more shares every single month. So how does SPYI make money? It generates income through a combination of 3 strategies. Number 1, dividends. Since it holds dividend producing stocks in a dividend ETF, you're going to capture some of those dividends. Simple enough. These dividends contribute to the fund's income, and they can only be stocks that are part of the S&P 500 index, the biggest 500 companies in the US. Number 2, it employs a call option writing strategy. SPY uses a data-driven call option strategy, which is just fancy talk for that it writes out of the money call options. This involves writing call options on the S&P 500 index, SPX. The premiums earned from selling these options provide additional income. Number 3, tax efficiency. This fund uses SPX index options, which are classified as 1256 contracts, which benefit from favorable tax treatment. If you were to write these call options on something like SPY, it would be taxed at 100% short-term gains. However, writing on SPX gives you 60% long-term and 40% short-term, so you maximize your after-tax income. SPYI writes it on SPX to capture this small tax benefit. By combining this trifecta of strategies, it captures that consistent high monthly income in a tax-efficient manner, while also providing the potential for equity appreciation in rising markets. So what are some pros and cons of SPYI? Pro number 1, it's a steady income stream. Who doesn't love getting paid just for holding on to something? It's like winning a participation trophy, but better. Number 2, it's diverse. You're not putting all your eggs in one basket since you're investing in the SPX index. You're not too heavy in one industry. Number 3, potential for growth. These companies can grow, and so can, and a portion of that will reflect on SPYI. They can also raise their dividends or even do special dividends. You capture a small portion of that too with SPYI. What are the cons? What are the drawbacks? Market risk. If the market goes south, so will the companies it's holding, so SPYI may lose some equity too. Dividend cuts. If companies reduce or stop their dividends altogether, SPYI will definitely take a hit as well. Expense ratio. You got to pay a fee for someone to manage this for you. It's like a cover charge to enter the dividend party, and it's quite high for this one, but then again, you're looking at around 0.5% for most covered call ETFs, so it's nothing too crazy. As with any covered call ETF, your upside is limited, so while SPY makes new highs, especially in this crazy bull run we've had for the past year, SPY will barely appreciate in price. Of course, that's common with any high yielder. If you want to capture more upside while still getting paid a monthly paycheck, check out something like SCHD instead. Lastly, there's no downside protection. While some of the CC premiums lower cost basis by offsetting potential losses, it doesn't have any puts in place. So in the event of a black swan event, SPY will likely capture all of the downside, just like the index it's writing calls on. If WW3 breaks out, both the index and SPY will take the losses. But then again, the market loves war, right? Most covered call dividend ETFs are this way. You can always buy puts in your own brokerage to set up a hedge just in case. Overall though, it can be a good option for investors seeking high monthly income and tax efficiency, but it's important to consider the associated risks and costs. SPY has had a strong track record of monthly dividend payouts. Here are some of the recent payouts in the past year. As you can see, most of it is around 50 cents per share. They're reliable with a current yield of around 12%. This makes it an extremely attractive option for income-focused investors. SPY boasts an impressive average yield. Here's some other data you can look at. If you didn't have DRIP enabled and you just collected dividends every single month, your annualized return would be just around 6.9. So if you just took the divvy payout every single month, could have used it for a Chipotle burrito bowl with double protein and guac without ever reinvesting a dime back into it. You'd still be up on your original 10K. The divs are basically free money. If you had JEPI enabled, your cumulative return would be higher. You would have picked up a few shares every single payout to put back into it to quickly compound your snowball. Your principal investment, your investment would be worth approximately $11,355. So if you were to cash out now, you would have made about $1,355 on your principal, and the dividends would have been free money. SPYI has been historically stable, but remember, past performance does never guarantee future results. The obvious ticker to compare SPYI to is SPX, or SPY, aka the market. Over the past year, SPYI has achieved a return of approximately 20%. While SPYI itself has outperformed it with a return of about 28.41%. SPYI focuses on dividends rather than capital appreciation. Additionally, SPYI has had a higher expense ratio of 0.68 compared to SPYI's measly 0.009, which can also impact their overall returns. But then again, you'd have to sell your shares of SPYI to get those gains, and it's been a crazy bull run for the market in general. It performs well in mildly bullish markets where the underlying stocks appreciate moderately. Since it writes calls, this can generate additional income without capping too much potential upside. If it were to spike suddenly, this does not bode well for SPYI. In markets that are stable or moving sideways, the income generated from selling call option premiums can provide a steady stream of returns even if the underlying does not move up or down. So in a way, it can milk the underlying without the underlying actually appreciating in price. SPYI does terrible in moderate bear markets. Declining in underlying stocks means that SPYI will decline as well. Since SPYI holds stocks that comprise SPX, a broad market decline will likely lead to a decrease in the value of these holdings since it does not protect itself with put options. While selling call options may offset some of these losses, it may not be sufficient to fully counteract its sharp decline in a strong bear market. It also has limited downside protection. As I just mentioned, the call options can cushion some of the impact, but it does not offer explicit downside protection. The fund is still exposed to overall market risk. So who should invest in SPYI? Personally, I think SPYI is good for investors who seek high monthly dividend income. If you're looking for a steady stream of reliable monthly income based on the data so far, SPYI's strategy of generating high monthly distributions can be quite appealing. If you want tax efficiency, SPYI uses SPX index options, which are classified as 1256, so you get that slight beneficial tax treatment, making it suitable for those looking to maximize your tax. If you want to capture some of the S&P 500 while also getting income from call options and capturing some of the dividends, SPYI might be a good fit. If you want to be diversified, SPYI holds a diversified portfolio of S&P 500 stocks, which can be beneficial if you don't want to be too heavy in one industry. In short, SPYI can be a solid choice for those who want the high yield and don't mind some up and downs. It's like a roller coaster, but with financial safety bars. So that's a wrap on SPYI. Don't forget to like, comment, and subscribe, and hit that notification bell so you never miss out on the degeneracy. I also want to give a shout out to my boy A.MP4 for letting me know that my mic sucks. I have since then resolved the issue. Thanks. Till next time, keep investing, keep compounding, and keep getting paid. Degen out.